What I am about to explain will sound unbelievable at first, but the silver market is approaching a fifth stage that almost nobody in mainstream finance is discussing seriously. This coming stage is not mentioned on financial television, ignored by most analysts, and misunderstood even by veterans who remember the dramatic silver crash of 1980. The reason this matters now is simple and urgent, because stages 1 through 4 have already happened, and we are currently sitting in the dangerous gap before stage 5. History shows that when markets enter this kind of transition zone, price movements accelerate suddenly, violently, and far beyond what rational models predict. To understand why stage 5 could dwarf every previous silver rally, you first need to understand that silver is not just jewelry or a speculative metal. Silver is one of the most manipulated, misunderstood, and structurally constrained commodities on Earth, and its current setup has never existed before in human history. Before explaining what stage 5 looks like, we must carefully walk through the first 4 stages, because the path explains why the ending is unavoidable. Stage 1 began quietly in 1999, when silver traded around $5 an ounce, and was so ignored that mining companies were collapsing without public concern. At that time, precious metals were considered obsolete, gold was dismissed as irrelevant, and silver was treated as an industrial leftover with no monetary future. Yet beneath the surface, a subtle shift was taking place as central banks quietly stopped selling gold after decades of aggressive liquidation. The most famous example was the Bank of England selling half its gold reserves near historical lows, an event later called one of the worst trades ever executed. That moment marked the psychological bottom for precious metals, even though almost nobody recognized its significance at the time. Silver began rising slowly, almost invisibly, moving from $5 to $6, then $7, then $8, while mainstream investors remained completely uninterested. During this period, informed capital accumulated patiently, recognizing that undervaluation and neglect often precede long-term structural reversals. By the early 2000s, silver prices were still historically cheap, yet the foundation for a much larger move had already been quietly established. Stage 1 was not about excitement or speculation, but about apathy, mispricing, and the silent transfer of assets from weak hands to strong hands. This phase created the base upon which all later silver movements would build, even though it appeared uneventful to casual observers. Without stage 1's prolonged neglect and underinvestment, none of the dramatic price behavior seen later would have been mathematically possible. Stage 1 ended not with headlines or panic, but with a slow recognition among insiders that something fundamental had changed beneath the market. That realization set the stage for the first explosive reaction, which would arrive years later during a global financial shock. Stage 2 arrived abruptly in 2008, when the global financial system fractured and exposed how fragile confidence-based markets truly were. Major institutions collapsed almost overnight, household names disappeared, and fear replaced complacency across every major financial center. In response, central banks crossed a historic line by creating trillions of dollars to prevent a total systemic failure. For the first time, money was printed on a scale so large that its long-term consequences were impossible to fully understand in real time. Silver reacted violently, not because of speculation, but because it instantly reflected the erosion of trust in paper currencies. From late 2008 through 2011, silver prices surged nearly 5-fold, shocking investors who believed precious metals were obsolete relics. As prices accelerated, commentators labeled the move a bubble and confidently predicted an inevitable collapse. They were correct about the crash, but completely wrong about what Stage 2 was actually meant to prove. When monetary systems are flooded with newly created currency, scarce real assets respond faster and harder than most models anticipate. Silver's extreme sensitivity to monetary expansion was revealed clearly for the first time during this period. After peaking, silver prices collapsed brutally, destroying leveraged positions and reinforcing skepticism among mainstream investors. By the mid-2010 seconds, silver was, once again declared, irrelevant, volatile, and unsuitable for serious portfolios. Yet beneath the surface, Stage 2 had already fulfilled its purpose by demonstrating silver's role as a monetary pressure gauge. It showed that silver does not move gradually during crises, but reacts explosively when confidence breaks. This lesson would prove critical later, when even larger monetary experiments were conducted. Stage 2 separated patient holders from speculative traders and eliminated weak hands through extreme volatility. What remained after the crash was a smaller group that understood silver's asymmetric behavior. This understanding laid the psychological groundwork for the next phase, which would arrive amid a global shutdown. Without Stage 2's monetary shock test, later silver movements would have appeared irrational rather than mathematically consistent. Stage 2 ended with disillusionment, but it quietly rewired how silver would be perceived in future crises. Stage 3 began in March 2020, when the global economy was deliberately shut down and the world entered an unprecedented financial experiment. Entire industries stopped overnight, supply chains froze, and governments responded with monetary force that dwarfed every previous intervention. Central banks created nearly $20 trillion in less than 2 years, an amount previously unthinkable within such a short time frame. This time, money printing was not a rescue measure, but a structural rewrite of how economies were expected to function. Silver reacted faster than ever before, surging violently as liquidity flooded markets searching for scarce, tangible assets. In just 5 months, silver prices more than doubled, moving with a speed that shocked even seasoned precious metals investors. Unlike earlier cycles, this rally was not driven solely by institutions, but by millions of retail participants entering simultaneously. Online communities demonstrated that coordinated retail demand could directly impact physical silver availability. Bullion dealers ran out of inventory, websites crashed, and physical premiums exploded, far above paper prices. For the first time, the gap between paper silver and physical silver became visible to the general public. Although prices eventually pulled back, something irreversible had already happened beneath the surface. Stage 3 proved that retail investors possessed enough collective power to disrupt the silver market structure. It also revealed how fragile the paper pricing system becomes when physical demand accelerates suddenly. The pullback was widely labeled a failure, but this interpretation completely missed the deeper transformation underway. Silver did not collapse because demand disappeared, but because momentum temporarily outran available supply channels. When prices stabilized, physical silver remained tightly held rather than returning to the market. Stage 3 permanently changed who participates in silver and how quickly sentiment can shift. The silver market was no longer controlled only by institutions, miners, and banks. Millions of individual buyers had entered, learned, and stayed engaged. This new participant base would become critical in the next stage, when fundamentals begin overpowering price management. Stage 4 is unfolding right now, and it is the least discussed yet most critical phase of the entire silver cycle. Unlike previous stages driven by psychology or monetary shock, Stage 4 is governed by physical supply and demand that cannot be manipulated indefinitely. Global silver mine production peaked years ago and has been declining steadily despite rising prices and increasing strategic importance. Most silver is produced as a byproduct of other metals, meaning higher silver demand does not automatically create higher silver supply. As copper, lead, and zinc projects slow or shut down, silver production falls with them regardless of silver's standalone value. At the same time, the easiest and richest silver deposits have already been exhausted after decades of mining. While supply weakens, industrial demand for silver has surged to all-time highs across multiple critical technologies. Solar energy expansion alone now consumes enormous volumes of silver that are permanently removed from circulation. Electric vehicles, advanced electronics, medical equipment, and communications infrastructure all require silver with no scalable substitute. Industrial demand is no longer optional or cyclical but structural, meaning it persists even at much higher prices. Investment demand adds another layer of pressure as physical silver is absorbed into long-term holdings. Exchange-traded funds now hold hundreds of millions of ounces locked away in vaults and unavailable to industry. This silver does not circulate back into the market during normal price fluctuations. The result is a persistent annual deficit, where more silver is consumed than mined every single year. To fill this gap, above-ground inventories are being quietly drawn down at accelerating rates. The most revealing indicator of this drawdown is visible in futures exchange registered inventories. Deliverable silver stocks have fallen sharply, even as paper trading volume remains extremely high. This imbalance shows that paper markets are expanding, while physical buffers are shrinking. Stage 4 is the setup phase, where fundamentals tighten silently while prices appear deceptively stable. Once this tension reaches its limit, the transition into Stage 5 becomes unavoidable. Stage 5 begins when the paper-silver market finally collides with physical reality and the illusion of endless liquidity can no longer be maintained. This stage is not driven by speculation or sentiment, but by an absolute shortage that forces price discovery into the physical market. To understand why Stage 5 will be historic, we must revisit the silver squeeze of 1980 and examine what truly caused its collapse. The Hunt brothers attempted to corner silver using leverage and futures contracts backed by physical delivery. Their actions drove prices sharply higher, but the squeeze remained concentrated in the hands of only 2 players. When regulators intervened, rules were changed and leverage was destroyed, forcing liquidation. Silver collapsed because supply still existed and could be mobilized once price incentives appeared. Governments released stockpiles, individuals sold silverware, and inventories flooded the market. Stage 5 is fundamentally different because those inventories no longer exist at meaningful scale. Today, Above-ground silver stocks are historically low after decades of consumption and liquidation. Governments have sold their reserves, and what remains is embedded permanently in products and infrastructure. Industrial demand today is structural, not discretionary, and cannot simply pause when prices rise. Modern silver demand is distributed across energy, transportation, electronics, and defense systems. At the same time, ownership of silver is now decentralized across millions of participants worldwide. This distribution makes coordinated forced selling impossible to enforce. Unlike 1980, regulators cannot target a handful of actors to unwind the market. The shortage driving Stage 5 is real, physical, and global. When delivery fails, confidence in paper pricing collapses instantly. At that moment, the silver price no longer reflects contracts but availability. This transition marks the irreversible shift into true price discovery. Once Stage 5 ignites, the separation between paper silver and physical silver accelerates faster than most market participants can react. Futures prices may continue trading, but they no longer represent the true cost of acquiring real, deliverable metal. Industrial buyers are the first to feel the pressure because silver shortages threaten entire production lines. When manufacturers cannot secure silver, they do not negotiate price. They buy whatever is available at any cost. This behavior triggers panic buying across the industrial sector, rapidly draining remaining inventories. At the same time, retail investors recognize the breakdown and rush to acquire physical silver before supplies vanish. Dealer inventories disappear within days, and premiums explode far beyond historical norms. Exchange-traded funds attempt to source metal to meet inflows, but available supply no longer exists. Some ETFs delay settlement, while others rely increasingly on cash substitutes instead of physical delivery. These actions further expose the weakness of the paper-based pricing system. Futures exchanges respond with emergency measures, including forced cash settlement and trading restrictions. Rather than calming markets, these actions confirm that physical silver is no longer available at posted prices. Confidence collapses rapidly as participants realize contracts no longer guarantee delivery. Price discovery shifts decisively to the physical market, where availability determines value. Silver prices move vertically, not because of speculation, but because supply has reached absolute limits. Volatility increases dramatically as every buyer competes for a shrinking pool of metal. Media coverage shifts from skepticism to alarm as shortages become impossible to ignore. Governments begin issuing statements blaming speculators while quietly scrambling to secure silver themselves. Export controls and regulatory interventions are attempted but fail to resolve the core shortage. By this point, Stage 5 is fully underway and cannot be reversed through policy or rhetoric. As Stage 5 matures, silver prices overshoot dramatically because markets always move beyond equilibrium when supply disappears. Buyers are no longer price sensitive, since access to silver becomes more important than cost. Each transaction resets expectations higher, reinforcing momentum and accelerating price discovery. Physical premiums expand faster than headline prices, signaling deep stress beneath the surface. At this stage, even small amounts of available silver command extreme bidding wars. Futures prices lag reality, becoming irrelevant reference points rather than actionable signals. Market participants who relied on paper exposure realize too late that contracts cannot substitute for metal. Liquidity vanishes as sellers retreat, expecting higher prices tomorrow than today. This creates a self-reinforcing loop where scarcity feeds confidence in further scarcity. Silver enters a vertical phase where price moves reflect availability, not valuation models. Media narratives shift from disbelief to inevitability as shortages persist despite interventions. New participants rush in seeking protection, not profit, intensifying demand pressure. Hoarding behavior spreads across industries, governments, and individuals simultaneously. Attempts to stabilize prices fail because no mechanism can manufacture silver quickly. Recycling responds too slowly to matter in the initial phase of the crisis. Mining projects cannot scale fast enough due to permitting, capital, and geological limits. The market overshoot continues until demand destruction finally begins at extreme prices. Only when substitution, shutdowns, and reduced consumption occur does upward pressure slow. By then, silver has permanently repriced far above historical norms. The market emerges transformed, with a new price floor reflecting structural scarcity. After the Stage 5 peak, silver experiences a violent correction, but unlike past cycles, the price never returns to previous historical levels. The crash shakes out late entrants who chased momentum without understanding the underlying structural shortage. Prices fall sharply from extreme highs, yet stabilize far above former resistance zones that once capped silver for decades. This new floor reflects a permanently altered balance between supply, demand, and inventory availability. Mine production does not surge because years of underinvestment cannot be reversed quickly, regardless of price incentives. Industrial demand remains resilient because silver is essential, not optional, for modern technology and infrastructure. Exchange-traded funds continue holding massive quantities of silver, preventing inventories from rebuilding meaningfully. The paper market survives only as a reference tool, no longer as the primary mechanism for price discovery. Physical premiums remain elevated, signaling lasting distrust in synthetic pricing systems. Investors who understood Stage 5 view silver differently, not as a trade, but as strategic capital. Governments quietly reassess silver's role in national security, energy policy, and industrial resilience. New regulations emerge, but they adapt to scarcity rather than eliminating it. The silver market becomes smaller, tighter, and far more volatile than in previous decades. Participation shifts toward long-term holders rather than short-term speculators. Silver reclaims its historical role as both an industrial backbone and a monetary hedge. The narrative changes from whether silver will rise to how societies adapt to its scarcity. Those who positioned early preserve purchasing power rather than chasing returns. Those who ignored the signals face higher costs embedded into energy, technology, and consumer goods. Stage 5 ultimately represents a reset, not just of price, but of how silver is valued globally. The silver market enters a new era defined by physical reality, structural limits, and permanent repricing.